Hi and welcome to Economies Bank. My name is Jonas, I'm head of asset management, and I will try to briefly go through our house view, which we think is quite encouraging today, given the fact that what we have forecasted for the fourth quarter seems to materialize, so far at least, which is of course a great development given our methodology, but also our portfolios. The methodology is the same. We do still believe in quant and econometrics. This is our overall house strategy, a house view. We still believe that we can see the peak Fed hawkishness. You can actually already see it in the written language if you do a natural language processing on top of the language, both in terms of minutes and speeches, I should add. Peak yields, yes, we have bought US Treasuries. I think we're pretty far out of consensus on that one. But we do claim that if yields should follow swap spreads, basically. Peak inflation is obviously playing out already, so that's more or less a little bit of a colder forecast in that sense. We have always forecasted that Q3 earnings will have positive surprises. We think, I mean, we're early days now in terms of the reporting season, but so far this is materializing. Earnings revisions have troughed, price targets have troughed, economic momentum has troughed where we are invested, and I'll come back to that very briefly. So if you go down to the bold, we are still overweight global equities. We forecast a rebound in Q4, we still do. And no surprises there. We still believe in a weaker SEK, which we fully exploit in our portfolios. And we believe in a stable but high vol, i.e. we have to be tactically very active. Our equities, in terms of global sense, troughed back in June. We strongly believe in what I have phrased as blockification, i.e. yes, you're going to have a rebound now in the third quarter GDP in the US to 2.5% positive growth. At the same time, you're entering a recession in Europe. This has to be already handled in the portfolios, I would argue, because otherwise you can be super bearish and be fully right, but you can also be constructive and positive and believe in a rebound and be fully right. So this is just a matter of being tactically active, I would argue. And we bought US Treasuries, we're taking profit in commodities and taking those down to the lower limits of what we can do. Now, in terms of 2022, as you're well aware of, this is a unique year that what usually happens when we enter troubles, recessions, is that equities sell off, but you get a lot of value on your fixed income portfolios. This is the whole core of the risk parity thinking, 60-40, 40-60 portfolios. And that has been the name of the game almost throughout history. 1994 is a bit different, which I think is quite a strong resemblance to what we're doing today. But obviously, in 2022, we can see that you have falling equities and falling fixed income. And I would argue, which we also anticipated, that you have to shift them in your portfolio management from the strategic asset allocation to the tactical asset allocation. Not everybody are able or allowed to do this. But if you are, you can find the troughs and you can play around the index and at least beat the index as good as you can. And we have chosen to be overweight equities in this instance because that's where we can expand our tactical asset allocation capabilities a lot more, i.e. we can be short equities, we can do spreads, we can do vol trades, we can design FX overlays and hedging, etc. Our trough in June is holding. This is the worst year for risk parity since 1926, and I think this is an epiphany of tactical asset allocation, and it really brought it back to the table. So the old saying that 80 or 90% of your portfolio return comes from strategic asset allocation, no, not true. That's been a false statement for some time, and today I think it's even quite dangerous statement. This means that in terms of an index, yes, we're outperforming, and we have been outperforming since 1st in 2018. Yes, we're beating our peers on a global equity basis. Yes, we're beating our global equity index. We're doing 10% per year. We're working now with longs, shorts, spreads, overlays in order to create this and very narrow strategies. But obviously, it's a great benefit for us to look at a Q4 potential in terms of rebound when we're already in the money since June. We're still down on the year, which we're working on, but obviously there's a big difference from global equities, which are making new lows as we were speaking, at least. This is a lot of text on this slide, but you have all the numbers. We want to be fully transparent on this. We have years when we did not match the global equity returns and so forth. And this is the currency mixture that we right now implemented. Basically, we don't hedge or use SEK share classes in any global equity portfolio that we're running. We want to keep this open in order to have this with us as a big tactical call actually. In our Nordic exposure, that is nominated in SEK, I should mention. That's why we have 8% SEK class. And this has shifted quite dramatically. We had 98% dollars on the 23rd of February, right before the war, and then 3 weeks later we start to take off that hedge or that position. Now, I'll switch around the orders of the slides, so now we're going to go straight into the coming week, because I think it's some quite interesting data points. We have US GDP growth for the third quarter, we have German GDP growth for the third quarter, and we'll look at Europe as well. We have some GDP data from Sweden and retail sales, but also you have house prices in the US. And this is an environment where US macro is surprising on the upside on almost every count. This is inverted recession risk in the US, which I think is gonna come back lower actually. So if I jump into the data, we can start with the house price data, which is quite important because we know that the mortgage rate has been increasing, and obviously the case Schiller, for example, has also been increasing. We think this statistical relationship will hold, i.e. the house prices has to convert back to some type of statistical relationship to the mortgage rates. Now, you can have large deviations around this as people change fixed variables, etc., etc. But the thesis here is that as the prices turn lower, which they already are in the US, we can start to see the end of this very vital variable owner's equivalent rent in the US, which is really pushing and making this whole rollover of the CPI number a bit slower than it should otherwise have been. So we're not really too nervous about falling, collapsing US house sector in that sense, but we do see a lower value on house prices going forward, lower growth, and that it will be enough to sort of turn this owner's equivalent rent. And when that happens, you have had to trade that 3 months ahead of time, because if you try to capture when this peaks, you're going to be way late in the game. Because we have to remember, fixed income market saw the peak inflation back in March. So this is sort of a slow-moving train, but you have to sort of trade it differently rather than waiting for it. But at least the data is developing quite nicely. So Q3 US GDP growth, we see 2.5% positive growth on a quarter-quarter seasonally adjusted annual rate. You have here the daily updated GDP models, 2.5 plus. We should remember that number when we go into Eurozone. In Eurozone, we're going to have IFO. We think we're going to tip into the recession camp pretty soon. We look at use of chemicals and chemical products in Germany, for example. We can see that we are on a very low level. We used to play this data on the rebound in order to position in German industrial equities. Obviously, we don't have that position right now. We have completely exited Eurozone from our portfolios, as you're well aware of. This is an old strategy for us. At the same time that the US is growing, 2.5 clicks, I think the consensus is 2.2. You are going to have GDP growth from Germany. There you have 90% recession risk going into Q4 and Q1. It was 20% before the war. Now it's 90%. The risk is so huge. We can see some data points pointing out this. We're waiting for the real economy to follow. Our basic conclusion from this is to have no exposure. At the same time, Europe will hike rates next week. 73 basis points is priced into the market. So it'll be quite interesting to see how far we're able to go in a collapsing economy. Obviously, they have to do something given the mandate, which is CPI, but it'll be quite interesting to follow where they're going to go, basically, and how far they're going to go. At the same time, Eurozone, as an aggregate, has an 80% probability of recession, and that has been penciled in the market to start this quarter, Q4, going into Q1. Again, we have zero exposure to the Eurozone equities, and this is something that we have been running for throughout 2022, actually even before the war. And it's something we're holding on to because we still need to see some kind of indicator troughing and rebounding, and we can't see that yet. This is all sort of put to a stress test in terms of financial risk and stress, which is quite high in Europe compared to US and China. And on top of this, we have Sweden, where we see the next leg in the GDP indicator actually on the downside. No big surprise in terms of what happens to Europe. And again, we have a Nordic allocation of global equities, and we're still favoring or still enjoy trading Swedish single equities But we have to be very careful in order to choose those equities that have less domestic exposure than international exposure. So we need to trade the Swedish equities that have Asian counterparties or North American or South American, basically. The core of the softness in Sweden, this is a graph we've been using since January, well actually November last year, this is a year ago. The slowdown in real estate has been a given for almost a year now. It's still something that we are very considerable and taking into account in terms of future positioning. Retail sales is coming on in the week. We have to remember that even before the Riksbank started hiking rates, Swedish retail sales was at a level, at a total collapse comparable to the Great Financial Crisis or the 90s crisis. So obviously with a high debt level, you can only imagine what would happen when you start hiking. A basic conclusion for this is to utilize the coming weakness of the SEK krona, which we have been doing all the year and we still are doing in our portfolios. So in terms of macro hot topics, I think it's nice to capture the paradigms. You know, we had a political risk, we had geopolitical risk, we have inflation, then you had financial conditions. Right now you can see financial conditions is turning lower. I think that corresponds quite well to the we see the end of Fed hawkishness and increasing weight on macro. Blockification, relative macro is sort of up and running now in the game, which is quite interesting. In terms of soft landing, hard landing, we have basically no new conclusion. We're still in a soft landing camp, firmly so. And that will probably be the name of the game, at least for the next couple of months. In terms of the energy crisis, yes, we see skyrocketing energy prices in terms of euro per megawatts, etc., going into November, December, January, February. Our basic conclusion is that we don't know if the future market will be right or wrong, but we keep zero exposure to Eurozone equities due to the macro. Yes, we are filling our natural gas inventories quite well, but we still have to see the positive effects of that in terms of energy pricing. Now, US is running into a midterm election. We're going to have a special event on that today here at the bank. We will be live streaming. I hope you can join us, but probably this move will be out after that event. But we also have a pod coming up in Swedish, though, where we run through what happened in the election. It will be quite interesting to follow. We're going to have a speaker from Washington give us really the feeling for what's going on here. Now, basically, our thesis going into the midterm election has always been that Democrats will lose their House of Representatives, but now also they seem to start to be a bit struggling in the Senate. That combination of losing both houses could be quite interesting from an equity market perspective, but we're not there yet. So this is something we're going to track going forward. Now, in terms of that, Democrats will lose. That's a given fact by both the FX market and equity market. But we also need to remember to separate between predicted as a source and 538, for example, which is obviously looking at polls. Without some differences here in terms of the statistical probabilities. But it's not enough to cause any doubt in terms that Republicans will come back and take over at least the House of Representatives. And we all know that one of their first agenda points will be to raise the question to impeach Biden, given what he said on tape in Ukraine back in the days. So this is a story that's not over. And as we write here on this graph, Trump never left. He's still running around in this mishmash of front runners for the 2024 presidential election in terms of, predicted at least. In terms of another hot macro topic, obviously inflation, the supply bottlenecks are plummeting, and this could have huge effects for inflation going forward. It doesn't really matter any way we turn or calculate or measure it, but it's plummeting for sure. The price inflation peaked in March, as we all know by now, and also consumer outlooks for 1 year ahead of time is down to 3%, and it's been there since summer. We've gone down from 8.6 to 3%, and obviously the break-even curve is also arguing for a lower inflation. And this is the reason why we hold on to overweight in equities, because if we knew this is going to happen, or predict it's going to happen, or that's our forecast, we need to be able to work with the portfolio so we can keep the asset class that could benefit the most from this, and that's obviously equities. Given the fact that we were able to create a trough in June where we spent our last cash and we flipped our short positions and took off our wall hedges, That has been with us to be afford basically to wait for this rebound in Q4. And I come back to why we've seen this and why we still claim that it would happen. Now, again, this goes also back to peak hawkishness, that even before we started hiking rates, we knew that we're going to end up cutting rates. And we still see that kind of peak hawkishness. We can see it in terms of probabilities on Fed fund futures. So obviously going to hike rates up to 4.75 to 5%, and then we're going to start to roll over and start to cut rates again. If these zeros start to break in, so the market start to pricing a probability of even higher hikes than we see today, then we have to probably rethink our strategy a bit. But we're not there yet. There are no signs that we're going to end up there, given that inflation is rolling over or has started to roll over. But it's something that we keep an eye on. I mentioned before the pivot, because we have to remember in terms of language, and when the Fed is doing their own natural language processing on top of their own language, which is obviously front run before they say anything, they are clearly signaling increased dovishness to the market. And that is why people are obsessed with this pivot. In terms of yields, I said that it's going to go lower because we believe the swap spreads will be leading as a nominal 10-year, and that's something we still argue, and then we have put a position on top of that. In terms of pivot, I think you can discuss that back and forth, but I try on this page, which is a bit complex, to envision for your eyes what a pivot could potentially mean in terms of equity market. A pivot means basically the Fed is going to start to turn around even more than they're doing verbally. So we need to calculate the current Fed rate versus a restrictive rate, but also put that on a cyclical adjusted basis by using a nominal GDP gap. And also put on top of that we know what the Fed is going to do in terms of Fed fund. We know what the Fed is going to do in terms of Fed fund futures, but also allow for these calculations to be on a negative term structure. When we combine all this, you have this graph, and I stopped the equation in 2018 and just let the data fill the existing equation. You can see a very interesting boom in the equity market. This is not our prediction that the equity market will grow with 40–50% on the top side, but it illustrates why the market is obsessed by discussing the pivot, because everybody understands, or think to understand, that is a potential quite big game changer basically, which I'm trying to illustrate here in numbers. We are positive on the equity market, a number of reasons for that in the US, i.e. we are looking at margin depth, we look at daily range indicator, we look at equity market sentiment, and it's quite interesting to see how sentiment turned around last week. Even though spot levels were down, you can actually see the sentiment started to climb. This is, I think, the second week in the past 3 weeks that you can see the Fridays is turning in lower in the spot market, but the sentiment turned around. So the market is seeking the upside basically. And if you look at highs, lows, advanced declines, bullish, bearish, you can see it even more clearly that the market is internally positioned for upside more so than downside. The market wants to be buyers, they don't want to be sellers anymore. And that's a big change. We saw the same change back in June. Obviously, we're hoping for the same type of rebound today. Another sign for this is obviously the breadth indicators are exhausted on the downside and starts to rebound. And we have to remember that the fourth quarter, if you look back from 1928, is a stable positive quarter. And today, obviously, we have a tremendously strong beginning of the quarter, which is good fun for us that forecast that, but it's also something that we need to make sure that we utilize to its maximum, given that we are, as a lot of others, are still down on the year in terms of global equities. On top of this, we cannot forget our daily trading model. In terms of counterparty risk, dollar liquidity, and vol curves, it's still on an upside. So that's really, really positive for the market. Now, in terms of Hubel liquidity ratio, we can also see the same type of calculations that people are not sellers; they want to be buyers in the market. So higher lows in terms of that calculation, which is also very constructive, of course. And on top of this, we cannot also forget that earnings revisions have troughed. Is the trough enough to bring us all the way back up to zero, even net positive? I don't know, we have to see. But that trough, you have to capture that trough, because that rebound is what makes a big difference in terms of your performance versus an index, if you capture it or if you miss it. We have to remember that global equities is also troughed and turned around. Now, if you combine the earnings revisions, price target revisions, and economic surprises, you see what I used to call a golden hook. Now it's more something else. But this is an old forecast for us that the end of the year will be strong on equity basis. We're keeping that forecast, and obviously it's a lot easier to sit here and say that today, given the strong beginning of the fourth quarter. But we believe and have believed, and has been our forecast, that the end of the year will be stronger on equity basis. Will it be enough to bring positive returns on the year? Probably not. But at least we can limit some of the damage that we have seen this year in terms of our portfolios. That the economy is rebounding is quite well known if you look at various economic surprise indicators. You can look at Westpac's, Goldman's, Barclays, Citi's or Bloomberg's. They're all indicating positive growth, so no real surprises there. In terms of GDP, we should not forget that whilst Europe is going into recession, we have never seen a recession in the US for 2022. We think that call was completely misguided. We don't see a recession for the next coming 3 quarters either. If you look at next 12 months, you actually have a 24%, sorry, this is my bad, it says 22, but it's actually 24 now, a recession risk for the next 12 months. That should probably pop up, given the fact that, if anything, we have been more concerned about Q3, Q4 2023, by which time the Fed will start to cut rates again, of course. Now, in terms of weekly OECD now-cost models, they have come back up and are on a stable level for the US. Now, if you be more fancy-pantsy and look at real-time SAM rules or Aruba, Diebold, Scott, the business confidence, you can't see recession either. So we decided to fade this talk and story about recession 2022, and we stick to it. In terms of actual recession defining data, we still cannot see any signs of a slowdown in the US. But then again, this has to be contrasted to Europe, where we know that we're right now entering a recession. We should also, I think this is a bit tricky also to keep in mind that in terms of global growth, if you look on the bottom right-hand side, we know that global growth is today in volume terms increasing by over 5%. That was a dream level if you look at the years 2012 to 2020. And today you enjoy that growth in trade between, for example, China and the US, South Korea, and obviously parts of South America as well, and India, etc., but not in Europe. And that's the big contrast we as Europeans, I think, has to handle with that. You can find value in, for example, US small caps. If you look on the return we have on our US small cap strategy before an FX overlay, we're talking about 10% since midsummer. It's a little bit of a contrast if you look on the US consumer and their situation in terms of debts, income, etc., with the Swedish consumer, for example. It's completely different ball games. So obviously you can find value in consumer segments, but I think you have to be a bit careful in terms of your tactical work, which has been the name of the game that I started off to explain. And that was pretty much all from my half, and I'll be back in a week's time with an update on this. But so far we think Q4 is playing out as we had predicted and hoped, and we'll see how far we're going to take us. Thank you so much for today.